Good morning and welcome everyone to the Money Control live stream. You are watching another episode of Markets with Santo and CJ. Well, it's a beautiful Mumbai morning this on a Tuesday, but things are not looking lovely on Dalal Street. It seems that fear and uncertainty have become the dominant sentiment in our market right now.
Well, CJ, this day had to come at some point or the other. You know, when there was a wild party going on last year, what most new investors failed to see that at some point market will correct its excesses, and that is what's happening right now.
You seem so happy about this. I mean, there's a smile, there is a hint of a smile on your face. I don't know why.
Look, CJ, I'm not gloating. See, I'll just tell you something that I told a trader many years back when I was a cub reporter. He was known to take a lot of short positions. So I keep telling you must be enjoying, having a good time seeing the prices fall. He said, no. He got angry at me. He said that, look, I also have a portfolio of shares. So while the conditions are such that, I must go short, I'm losing money on my main portfolio. I guess the same holds for, you and me, right? We can talk about markets falling, but the fact is that we also have got our retirement money in mutual funds. The value of those go down too. Let's not forget that.
And some directly in stocks. That said, stocks are looking likely to be opening in red. The Nifty futures on the Singapore exchange are indicating a deep cut in the market, although it has come significantly off the lows of the days that we saw about 2 hours ago. Much of this weakness is coming from the US market. Yesterday, US market had another crack. The S&P index fell over 3%, Nasdaq fell over another 4%. So it seems that growth fears are now overtaking inflation fears, because there is a concern now that because central banks are going so aggressively against beating down inflation, they might end up restricting output or economic growth going ahead, and that is now, it seems, taking precedence over inflation.
Well, that's true, fair point, CJ, but if you still look at the Indian market compared to how the global markets have done, I think there is no visible sign of panic yet. The kind of steep falls, 3 or 4% falls that we have been seeing in US markets. Ideally a market like a more shallow market like India should have seen those kind of cuts, but that's not happening. So that goes to show the strength of retail money that's flowing into the market. Market right now, of course, thanks to the
and we are not shallow. We are not as shallow as we used to be because of the sort of money that retail investors have pumped in.
If you look at the investable universe of stocks, that number has not still gone up in a big way over the last year.
I take your point. The universe has probably not expanded, but the money that has come into that universe has definitely expanded multifold.
But that said, the weak rupee is definitely a cause for concern. Typically, when the rupee is weak, you see foreign institutional investors, selling Indian stocks, and we've already been seeing that, they've been continuous sellers for a long time now.
जाने दो यार, वो लोग बेचते रहेंगे, हम खरीदते रहेंगे, और क्या? We have been buying, right? We have been supporting the market. Domestic investors have been supporting this market.
That's been your pet theme, but let's see how long investors are able to stay patient in the face of, stock prices falling. And remember, most of the cuts over the last few days have been happening in the second line shares, not in the front line shares, which is why you're seeing the index a little more steady compared to
they were
what's
outperforming
happening
also for the past 2-3 weeks. So it is very natural that some investors would be taking profits there. That said, that is the macro check on the market, but it's time to quickly dive into some of the stocks that we want to bicker over, right?
Yes. So starting with CDSL, the company had reported a good set of fourth quarter numbers. Now, CJ, you can't be bullish on the Indian capital market story and not be bullish on CDSL. That's my simple argument. It's got a dominant market share. There are just two depository players.
CDSL had its time, Santo. It rode the Robin Hood wave for 2 years, but it seems that there are doubts now emerging over the sustenance of growth. Because valuations have become expensive, and generally if you overshoot what your average is or what your mean is, there is always a tendency to come back towards that mean, and CDSL recently is exhibiting those tendencies.
Well, CJ, look at it this way. We still, for a country of 130 crore, we still have how many demat accounts? That's 8 crores in all, but 8 crores again, if you do away with all the duplications and stuff like that, it would be barely about 4 crores. We haven't even got started. Now, the explosive growth, it may seem that, that was explosive growth, but if you go forward another 5 years, probably this may still be, this may still look like peanuts.
I'm sure when you were a cub reporter, this argument was, doled out to you as well.
And it's turning out to be true, but there were people were not as bullish on equities at that point in time, as they are right now. So, okay, and about valuations, okay. the compounded earnings growth, net profit growth for CDSL has been 40% over the last 3 years, and it's quoting at a PE of 39. Now, you can see some bit of moderation there, which is again only to be expected, but then, hey, there are only two depository players, right? CDSL and NSDL.
Let's talk about returns, right? Past 2 years of returns, great. Past 3 months of return, not so great. Past next 6 months of returns are not looking that great because, as Zerodha said itself, there is likelihood to be some bit of slowdown in user acquisition, right? Because people are again coming back to offices. They don't have free time in their at their home after work to go out trading in the market. They don't have that time anymore. They are out commuting. So therefore, user growth is going to slow down. It's not like it is going to fall drastically. It's no way a bad situation. But the slowdown itself will mean that incremental capital will not come to CDSL anymore. There are better opportunities.
This is the opportunity, and that is when, when stocks correct, that is when you get in for the long term.
Look at the technical setup of the stock. Bearishness is written all over it. It is on the verge of a death cross with the 50-day moving average now looking like it's going to go below the 200-day moving average. What is a death cross? Death cross is probably one of those things that technical analysts fear the most. It indicates that there is going to be a period of lull in the stock. There is going to be a extended period of weakness in the stocks. And that is why I'm saying this year the stock will not make money for you.
Well, CJ, seen another way, I would be very worried. If the number of demat accounts are going to slow down, probably it says something about the market as well. Your stock.
We'll talk about, we know that, see, it's not about slow down, right? If you had a base of 2 crore and you have a base of 4 crore now, and you probably have a base, if you go by actual reported numbers, you have a base of 8 crores now, the base is higher. So therefore the volume or the volume of money that has come in is higher. There can be slowdown and incremental growth, right? But that will not affect the overall market because that money is already in.
Okay, so CJ, point taken. Let me hear your next talk for the day.
Panic mongers here. That said, SRF is one stock that, oh man, it's a multi-bagger that keeps on giving, that gift that keeps on giving, delivering for life.
Well, CDSL was in the same spot, some time back.
And it is something similar not backing what SRF is backing. Everybody was so fearful and so skeptical that, oh, chemical names are not going to do well. Looking at the earnings that had come in before SRS, everybody was thinking, margins are going to go down, volumes are going to go down. And the company has, put the face of a lot of the skeptics in the mud when it comes to earnings. The March quarter earnings were great. If you look at the profitability, if you look at the margins, if you look at PAT and sales, all were above street estimates. And the best thing is that because the street was so, skeptical, the stock fell about 13% in the past 3 months, fearing that that the Q4 will be bad. Now that the Q4 has been great, it is a perfect setup for a good rally on SRF.
It is perfect setup, but that rally just doesn't seem to be happening. And see, smart money was not even getting into the stock despite knowing that the fourth quarter numbers were going to be good.
No, they did not. They were skeptical. That is what I'm saying. They did not know that the fourth quarter's numbers are going to be good.
You see, CJ, sentiment, for the market as a whole has changed. And right now, bears are going after any stock which, is richly valued.
Well, if they go after this stock, they're going to get burned, is what my opinion is.
No, don't worry about that. Chemical stocks, overall, the mood for them has changed. Classic example, Deepak Nitrite, strong fourth quarter numbers, stock not going anywhere. Navin Fluorine, look at the numbers, but look at the stock performance after that, still struggling for direction. SRF is the same case. Now, SRF at 40% trailing, P, right? It is among the expensive names in the sector.
It is because it has given stellar growth in past 5 to 6 years.
Don't doubting the fundamental story there, but this is not a stock that one would want to add right away, given that valuations are on the.
I think if you look at the technical setup for SRF, the fact that there has been a lot of profit taking on this counter for the past 3 to 4 months, expecting the sort of argument that you are making about margins, about possible sentiment being turning for chemical stocks, because valuations are also run up in 2021 when this sector was going doing very, very well. I think all of that skepticism is actually a good contra play on SRF. If any stock you want to bet on the chemical space, it is SRF. I would Deepak Nitrite, Navin Fluorine are all great plays. Okay, I mean they are all good long term plays. But at this point of time, SRF would remain the sector leader that it has been for the past few years.
It is not showing any signs yet, but well, anyway, I'll CAMS is the other computer. So CAMS is the next tech stock on our watch list. This is a dominant player in the mutual fund RTA space. It's done pretty well over the last 2 years now, a big play on the explosive growth in the MF space. And
Yeah,
you've
the
seen-
explosive growth, which has the MF stocks actually sinking to 52-week lows. Wow.
Oh, see, that's the difference.
You're
CJ.
counting on a play on an industry which in itself is not getting any bhav from the market, right? Wow.
Okay, no. It is very different there here. See, it's understandable that people are slightly skeptical on direct MF plays. That's because MFs can lose market share. You know, their fortunes change with the market, right? Rise and ebb. Not so for CAMS, right? It manages all the back end for MFs. Once an MF is locked in, it means a steady source of income, recovering income, and CAMS is the equivalent of the CDSL in the equity space, in the MF space.
Boss, the past 2 years of growth were not that much driven by MF revenues than the non-MF revenues. As much as they are registrar for a lot of the mutual funds, they are also registrars for a lot of companies as well, right? They also benefit a lot from the direct equity play as well. That was the main driver of growth for the past 2 years.
No, 70% market share in the MF
That is true.
RTA
They have MF good market share in the MF RTA space, but they were also benefiting a lot from the direct equity play as well, right? Because a lot of companies have also been. If you look at the past 2-3 months, a lot of companies have been, changing or rotating their register of companies, and KFIN and CAMS both benefit there because they are the two big players out there, right? Now, the non-MF revenues, as I made the argument for CDSL, it is very likely that the non-MF revenues will slow down going ahead, at least in the near term. It is a longer term play, true. 5 years, 10 years, if you look at it, the sort of growth, explosive growth and equity participation, true. The longer term story is there. But in the near term, this stock is not going to make money for me. I am not willing to bet my money that this stock is going to grow as fast as I want it to grow. Plus 12% CAGR growth in sales in the past 10 years. You're kidding me. It does not even stir the risk appetite.
40% growth in net profit in bottom line. That is what ultimately drives valuation.
Net profits can be grown by cost control. Sales is an indication of how much market you are getting, right? It is the indication of how much the entire market is expanding. If the market is not expanding, you can talk about net profit growth being a more dominant factor, right?
Well, CJ,
you're talking
operating margin is as high as 45%. So when you have that kind of an operating margin, even a 10 to 12% growth in sales is decent enough. So that's the kind of money that's flowing into the bottom line.
Just does not stir my risk appetite, my friend. Anyway, that side, another stock that's not going to stir my risk appetite is Rainbow Medicare. It's going to debut on street today, going to list on NSE and BSE at 10 p.m. Well, we talked about this earlier also in the show that the IPO was priced very unattractively, and we saw that in the sort of bids it received. It was not a very spectacular issue given the sort of reception Campus Activewear had got just a day or two before. So in that sense, I'm not really expecting a very good listing from the stock. The grey market premiums are also indicating a 3% sort of a premium, which by the time it lists, it probably will be evaporated. So for me, this is one counter that I will probably steer clear of.
I can't find anything to pick holes in that argument. I would agree with you. I think it was aggressively priced, and that clearly is showing in the grey market premium as well. And now that overall market mood is very bearish, overpriced stocks, as I said, continue to take it on the chin, and probably you could see Rainbow Medicare.
Yeah, you should agree with me more often, Santo.
Yes,
it'll be good for you.
Yes,
it'll be good
I agree.
For you. That said, another stock that is really, it's basically sort of an SRF story, which I believe is going to do pretty well, is Godrej Agrovet. The March quarter earnings again have strengthened the outlook for the company. Overall, 45% sort of 35 to 45% sort of growth in sales, similar sort of growth in reported profit actually grew by about 82% if you look at the reported profit that the company came out with. Now, this is a sector that is probably this is a stock that belongs to a sector of edible oils and food oils, and Agrovet clearly benefits from the rise in crude palm oil that we have seen. Now, if you go by the chatter on the street, the edible oils space or the food oil space is going to become the IT and steel of 2022, right? We know that IT sector and steel sector dominated the gains in 2021, and
they've come off sharply also. They are
it's not about coming off. At least we can make money in 2022. That is what matters to me right now. Where do I make money in this sort of a market? Edible oils space clearly seems to be that space, and it is a story where the fundamentals are also supporting, because We know that there are supply shortages in the food oil market globally with what has happened in Ukraine with soy oil and sunflower oil, what is happening with Indonesia with the export ban on crude palm oil. There is a clear supply shortage, and a producer like Agrovet, Godrej Agrovet, clearly benefits from a higher prices, and that will reflect in earnings and therefore on the stock performance.
Well, on that note, the markets are just a few seconds away from opening. Yeah, they have opened now, and I expected
it's a red. Yeah, but considerably better. Considerably
because I think
yeah.
there was some panic when you looked at the overnight US markets, but however, we're not seeing that kind of a deep cut.
Sensex and Nifty are down about 0.3%. Nifty mid-cap is down only 0.2%, so we are outperforming today. Nifty Bank about 0.3%, so leading the losses on the headline indices there. If you look at some of the individual counters, the losses are being led by ONGC, of course, with the crude oil prices dipping more than 5% overnight. That was pretty much expected. Hindalco, Reliance, Tata Motors are the big losers at this point of
Sensex
time.
has already moved into the positive territory now.
Yeah, Nifty is also making a play towards the positive.
A lot of short covering, but there's also a word of caution from Chris Wood of Jefferies. He's saying that in an interview to CNBC TV18, he said that market is still nowhere near the bottom.
Absolutely. I mean, look at our market only. It's down about only 11% from record highs, whereas the Nasdaq has fallen 27% from its record highs. So clearly there is a divergence here in performance, and we need to see. I hope that the earnings momentum and the sort of money that domestic investors are putting in will probably restrict the losses that we will see. But I'm sure that you have a different point of view there.
Well, on that note, it's a wrap on this episode of Markets with Santo and CJ.
Yeah, and we will catch you live again at 3 p.m. with all the day's action. Till then, please post your feedback on the comment section below, and do follow us on the social media links that you can see at the bottom of your screen.
Have a good day.
Yeah.